Watch is brought to you in association with Regent Business School, teaching different things differently.
Welcome to Stock Watch with me, Ntawuleng Lechela. And joining me to unpack your stock-related questions today are Jared Hoover from All Weather Capital and Talya Ginsberg from Umthombo Wealth. Be sure to send your questions through via email to stockwatch@bdtv.co.za, via SMS on 41392 or on X at Business Day TV using the hashtag StockWatch. Talya, Jared, thank you so much for your time this evening. Talya, I'll start with you. What are you making of sentiment today? Trade does look choppy. We did see the JSE closing mostly in the red, some green coming through out of the financial 15. Was that all on the back of 91?
If I'm frank, I don't know on a granular detail what is driving the financial 15 today, but it's nice that there is one green shoot. Otherwise, yes, I have to concur with you. It has been quite a lot of reds on the JSE today.
Mm-hmm. Jared, let's get your thoughts around that, and maybe we can broaden it out a bit and look at global markets. Trade also quite choppy on that front, but what we are seeing is a AI sell-off following Broadcom's earnings. They didn't miss expectations. However, it seems like the guidance disappointed. Is the sell-off we saw warranted? I think it was down 15% at one point.
Yes, in Ntawuleng, I think you're very right. I think this whole AI-led sell-off has really been driven by those Broadcom results. And I think that the starting point is really that the stock is trading at about a 32 PE. So typically at those levels, there isn't much room for disappointment. And as you pointed out, the 3Q guidance was a bit softer than people expected. So I think with that, you've seen a broader sell-off across the adjacent names. But we also need to put that into context. I mean, over the last kind of week, the stock was up 25%. Since March, it's up 70%. So it hasn't given back all of that. So it's normal to have a bit of a correction. And I mean, that price action might have also been exacerbated by the fact that we have leveraged ETFs in the space. They've attracted a lot of capital recently. And as soon as you see guidance misses, you can sort of see some deleveraging there. And that's, I think, has sparked a bit more of a negative price reaction than we may have expected.
Yeah. And, you know, I was going through some market commentary earlier on, and some analysts are saying that the sell-off is being fueled, or rather the broader sell-off within the tech sector is being fueled by some of the upcoming IPOs, Jared, with some investors perhaps taking profits with ambitions to get a piece of the pie when it comes to that SpaceX IPO.
Yes, so that's very interesting. I think it's one that we're all watching with bated breath. I mean, to me, it looks like there's a few interesting things to point out on that listing. One is that the IPO price has already been set, which I don't know, maybe it speaks to some of the eccentricities around Elon Musk. But at the same time, if we look, there was some capital raises done ahead of this from other peers in the sector, and there was sufficient demand. It was oversubscribed. So I think you will see sufficient demand come through for this particular listing. I mean, it does look expensive at 94 times, but I don't think that's the way we should be looking at it. There's a broader bull case at play here across, I mean, Starlink looking to take on global telcos. There's moats around their launch economics. There's the whole space economy, which hasn't even started yet. But the moment that companies start to expand their TAM, you typically see higher valuation multiples. And that's before we even get to something like the AI play, which isn't very big, but it was being talked about in some of the IPO documents. So I think it's really a play on Elon Musk. If you like him and where he's taking this business and taking us into the future, then it probably is one to watch and does keep us interested.
All right, and talking about listings, let's bring it back home, Talya, with Canal Plus. The viewer here saying, given that many analysts are saying Canal is not an attractive buy for South African investors after its JSE listing, is the stock worth considering at all? Should investors avoid it for now?
I think it's unfair to just straight out say avoid or don't avoid. I'd say at least you could stay on the sidelines. I wouldn't say anything as definitive. Ourselves, no, we're not looking to buy at the moment. DSTV, sorry, multi-choice was under a lot of pressure, as you'd know, before this merger and before this listing, and it would still make up about 28% of their revenue. Canal does seem very buoyant on the Africa story, and they would really have to come through with those synergies that they claim. And so you still watch. It's still interesting to have South Africa's first French listing,
Yeah.
but at the moment we're not looking to buy.
And Jared, your thoughts around that? I mean, one of the biggest selling points here when it comes to multi-choice as a whole is their play on sports, right? What is expected longer term for Canal Plus with that JSE listing? There's also talk about it likely being added onto the JSE top 40.
Yeah, so I think you touch on a few important points in Taoleng, and let me just hit on some of those points. I think for us, if we look at Canal Plus and where the market is pricing it, it's either telling you that it's giving you the value of multi-choice, given the purchase price at about 55 billion rand, and then it's you getting the rest of the Canal Plus business, that's the European business, its African footprint, some of its minority investments in Viaplay and View, for free. Alternatively, you're getting the Canal Plus business and you're getting the entirety multi-choice as a standalone business for free. So it does look like it's cheap. But at the same time, I think there's a number of vectors that they need to execute on. I think the first is that they need to turn around the South African business because that's the short-term cash cow. I think they need to grow the African volumes, which I think they may be able to do, but it's going to take some time. They need to improve the margin in the European business, which looks like it'll be a tall ask. And I think they need to realize the synergies in this business, which is a big number. But I don't think it's going to happen in the short term.
Yeah.
I do like the management team and them executing, but it will take some time. And I think if this business could be worth 2 times what it is now, I think we can sit and wait on the sidelines for them to show us or execute and show us the data points and then get involved in the name.
Yeah. So you do think that there's an investment case for pay TV in this current climate where we are seeing, such hectic competition? You look at the likes of your Netflix, there's even YouTube, right, which is free practically.
Yeah, no, I think you touch on very important points there because those are the competitors that are definitely stealing eyeballs and stealing viewing time. I think South Africa is a very unique market compared to the rest of the world. So I think it's going to be difficult for them to turn around in South Africa. But if we look to the African continent, 90% of the households on the African continent still use old technology. That's because data prices are expensive and fiber penetration isn't quite there. And then you've also got the fact that if you look at France, which is basically where Canal comes from, that market is very penetrated, but they were still growing subscribers from 2020. They did undergo a restructuring. So there is a bit of a playbook there. It doesn't mean the same playbook can be used in South Africa and in Africa eventually when fiber penetration goes up.
Yeah.
But I think they do have a blueprint to work off. So I don't think it's an all fall down story. It definitely is a bit of a turnaround. There is some work to do. But I think we can wait for some of the green shoots on those first.
And talking about turnaround stories, a company that's been hard at work over the past few years is Ayoko, Talya, formerly known as EOH. A question reads, my average price is R3.37 with the current levels of R4.15. If I hold for another 4 years, is this a good investment?
So I don't know if that question specified when they actually bought it. So it has been one of the great turnaround stories or even rebranding stories of the JSE. They used to be EOH. Being a journalist, you'd know more than me. They were enshrouded in glory. They changed their name. They changed their management team. And they moved on. They started going from loss making to actually turning a profit, and they've done fantastic in that regard. I have to give credit where credit's due. Your viewers asking where it will be in 4 years' time. Yes, if we all had a crystal ball. But but if it, I don't know if it will follow the same trajectory it did last year, or the past 2 years. It's come off a very low base.
Yeah.
But if you, as a investor, you have a buy and hold, and you compound, and you get that every year, generally speaking, you'll do well most times. So I think just the mentality of holding a good share you believe in is one that your viewer should stick with.
Jared, is Ayoko on your radar?
I don't think we have a lot more to add to what Talya is saying, but I mean, typically when you have these turnaround stories, it's never quite clear when the turnaround is happening, but you typically want to be in at the start of that, because equities are really about rate of change, and the biggest rate of change typically happens at the start of these turnarounds. And it feels like Ayoko has probably gone through the best of it, and I guess most of the share price gains are probably been had. So going forward, as they mature out of the cycle of the turnaround, I'm not quite sure whether the rate of change going forward of the current base is going to be as stark as it was historically. And if that's the case, there might be more interesting prospects in the rest of the subsector.
And just taking in that small mid-cap space, Talya, are there any companies you're keeping your eye out on at the moment? I know the macro picture has changed, and SA Inc. Has really been hard hit over the past few months. That, of course, including those small mid-caps.
Shame. I'm smiling, but it's actually been a very tough few months, which is why you just have to smile through it and get through it. So at our house Umthombo, we do generally like to look at small and mid caps. And it's something you can't paint every small and mid cap with the same brush. They're all different companies, and I think there are a lot of gems. Unfortunately, due to their size, they are overlooked by bigger investors, but as I said, there are some good ones out there. A week or two ago, my colleague came out on the show, and his stock pick was Signia. My stock pick will probably fall into that mid-cap category. One thing we've also done well with and still like is Lewis. And so there's some interesting shares out there, and there's some interesting stories. And given the sell-off in SA Inc., you can always pick up a good business at a bargain.
All right, Jared, you're up next. Any value in those small mid-cap players? I mean, Talya mentioned there that we've seen, a big sell-off in those players, and perhaps this presents a buying opportunity.
Yeah, I mean, that's a good point. Sometimes the small and mid-cap space almost feels like the missing middle at this point, because they're all probably trading on mid to high single-digit PEs. It's relatively cheap. But then you compare them to some of the historically bigger sectors in our universe, such as the retailers, and a lot of them are also trading on, called that high single-digit PEs. So maybe they are lacking the attention they deserve. But I think in that space, one that comes to mind is Coronation. It is a company that's trading on probably just over a 10% dividend yield at the moment. And historically, if you go through the cycles, every time this company touches close to 12 to 13%, it's been a pretty good buying opportunity. So I think if you dovetail the fact that you are getting paid to wait for a cyclical recovery in global and local markets, it's not a bad one to hold. And you'd argue that there could be about 20% upside, as it looks like their global kind of offerings have started to perform a little bit better.
Now, within that financial services realm, Talya, I want us to shift gears here and chat about the insurance sector. A question on Sanlam and whether it is a buy at current levels. I think the group was out with an operational update about a few weeks ago, and markets didn't like it.
Sanlam, it's actually always been the top of for us in terms of the whole insurance sector. And there's some decent on OUTsurance. It's been a great growth story. It's I don't know what you'd call it. It would be its child come. That's not the word, but Santam also I think came out with a decent update last month, and I think just in terms of the the short-term insurers, sorry, that's the correct word, short-term insurers. I think the weather, it's supposed to go into an
Yeah.
El Nino, which I don't know if it's great for the farmers, but at least there won't be any floods, which I think would be great from that perspective. Less floods, less hail. So we're more buoyant on the banks if you want to look at the financials, and then um, even a good asset management company or two, as Jared alluded to before. But I think if you're going to go for an insurer, Sanlam really is it really is a solid company. They're very conservative with how they report, so they're probably underselling themselves, if anything.
Are you seeing value there, Jared? I mean, I think I had your colleague Shane Watkins about 2-3 weeks ago, and he made quite an interesting comment on the insurance sector as a whole, saying that Discovery has the best growth headway, Old Mutual more of a recovery story, whereas he was more pessimistic about Sanlam.
Yeah, I think Shane made a few good points there. I think maybe just to add on to that, if I was going to pick one in the space right now that I think is a little beaten up, I think Santam would probably be my pick. I mean, if you look at their 1Q 26 update, it was a little bit soft. I think they were impacted there by some adverse events. And we can probably expect the second quarter to also be a little bit weaker than expectations given the flooding and the
Yeah,
fires we've seen in the
yeah.
country. But I guess the thing about equities is they are inherently forward-looking. So if we can look through this noise that we see over the next 6 months, it would actually present an ideal buying opportunity for the stock because you want to buy them when you have these adverse events impacting earnings, lower margins, and then after that you start to see a bit of a normalization in the base. On top of that, I mean, it is a good quality company. Valuation's inexpensive on a range of metrics. It's got about a 25% ROE. So I think that would be my pick in the space at the moment.
All right, back to questions. Jared, I'll stick with you. A viewer asking for your views on Afrimat, saying it's trading close to its underlying value. Is this a good buying opportunity on weakness, or is there still more downside risk to the stock?
Yes, so I think historically our view about Afrimat has been that the company has been run by an above average set of managers, very good at capital allocation historically. They've done some opportunistic acquisitions at the right point in commodity cycles and then ridden those out. And we've seen that in the share price reacting positively over the time.
Yeah.
But now we actually think it's more a collection of subpar assets in this business that are probably difficult to turn around. And I think that the capital allocation of the past may not necessarily be the same going into the future. So it's one that we would prefer to just watch from the sidelines for now.
Yeah, another turnaround story there, particularly when it comes to the cement business, Talya. In the last earnings, we did see the losses within that cement business narrow. Are you seeing opportunity at the moment, or are you, just like Jared, choosing to watch from the sidelines for now?
So originally, we very similar to what Jared was saying. It was seen as an above average management team. I believe also iron ore and all that was doing very well. And so the company was making probably above average profits, very loved by the markets, and quite doing very well for us. And then they bought Lafarge, which they claimed they bought it at a steal, and it's been giving them a tough time. And so we're actually one that we're quite hotly debating. And it's one, as I said, one that we kind of see both sides of the story clearly, but we're still debating on how we see it.
Yeah, a sector that's actually been having a tough time is the retail sector, particularly the clothing retailers, Talya. And there's a question here on TFG and whether you are buying at current levels. Results out from that company tomorrow.
TFG is a very interesting one because I've seen it's made a lot of other asset managers' radars just because of the valuation alone. It's probably, I don't know if it's at all times low for the share, but it's very cheap. It's dropped over 30% year to date. And it will make a lot of the managers' models just go green. Objectively, it's one that we've never really been too much a fan of. I think people have short memories, but they did do a capital raise in 2020. They used that money instead of just using it to save them. They went and they've done a lot of acquisitions, white space and all that. And they're very complicated. They in a lot of different countries, Australia, the UK. And so I suppose a few things have to go right for them, and it will more than justify these valuations, but we prefer to be on the sidelines for the time being.
Are you on the sidelines when it comes to TFG, Jared? Talya making a good point there around the acquisitions, some of the acquisitions it made that haven't gone well. And now we also have a counter like Mr. Price looking to enter the European market. Markets didn't like that at all as well. So maybe let's put up a counter like TFG and Mr. Price at the moment and where you're seeing value when it comes to some of those clothing retailers. I know a fave is usually Pepco, but let's take that out the realm at the moment and we can chat about those two.
I was going to say that. But I mean, to your point and to Talya's point as well, on TFG, I mean, it feels like the company's just been suffering from a range of structural issues. And although it might come up on a load of asset managers' screens, high single-digit PE, mid-single-digit to high single-digit dividend yield, the question is, I guess, is this value or a value trap? And the profit warnings have continued. It feels like they're just managing too many brands within their stores that are really targeted towards the mid and upper LSM market. The UK apparel market is not doing too well. The Australian macro is tough. So I think we're just cautious about calling the bottom just quite yet. And I guess we just would like to see some more traction on some of the levers that they can pull to arrest the decline in this business. Be that rationalizing the portfolio, exiting the Australian business, or maybe even shrinking some of the South African brands. But I guess that brings me to one of the points you made around Mr. Price. And yes, the company has given up about 14 billion rand of its market cap since it announced that NKD acquisition. But I guess the other thing that we think about is the company still wants to grow that NKD footprint. And the magic equation in investing is, can you generate a return above your cost of capital? But if that growth is going to come at a return that is way below your cost of capital, there could potentially be more downside in this business once we have firmer targets and numbers around those growth aspirations. I mean, we do admit that the brands and the clothing business in the South African portfolio are good businesses. I guess it's just a question of weighing that up against their aspirations in Europe. So probably one that is cheap, but I don't know if it's cheap enough.
All right. Let's get into your stock picks. Jared, I'll stick with you. Where are you seeing value at the moment? We have about 40 seconds for each of you.
Sure. So I'll try and keep it short. Mine is MTN. Generally, we like the fact that the company is delivering superior earnings per share growth over the next 3 years or so. That's also being reflected in superior free cash flow growth. And I think that there is an argument to be had that the valuation multiple for this company is still too cheap, given the risk profile is dropping because the companies or the countries that it's exposed to have stable FX, on top of the fact that they've recently done this IHS transaction, which is earnings accretive and NPV accretive. And there's also a few short-term catalysts. We've got their capital markets day next week. Hopefully we'll get some color on the business model. And then last point to mention, there's look-through value from a peer like Airtel Africa, who are listing their mobile money business, which may force some investors to look at the business on a sum of the parts value. So we like MTN.
All right, Talya, what do you like? Where are you seeing value at the moment?
As alluded to, I'm looking at a small cap. I wanted something quite boring, a good old-fashioned value case, and I'm going with the Invicta. So they could be defined as an industrial holding company, and they're trading very cheap, about 35% discount to their NAV, to their book value. Last year, they actually spent over 700 million buying back their preference shares, which means that money which would have been obligated for preference shareholders are now will be going back to ordinary shareholders. So at least you get a nice, easy tailwind there. And as I said, they're very cheap. So you just need a little bit of a re-rating or even just a little bit of bottom line growth. And you're doing pretty well.
All right, let's leave it there. That's all for Stockwatch today. Thanks to our guests, Jared Hoover from All Weather Capital and Talya Ginsberg from Umthombo Wealth. Up next, the close.
Stockwatch is brought to you in association with Regent Business School, teaching different things differently.